Coming up in this show, I'm going to give you my comments on the markets. Katie has trade planning with options, and she's going to give you a trade setup in Google and tell you why. I'll bring you tools for text. This is a brief video where I'm going to show you the slim ribbon and cycle analysis combined together and how that's negative for Apple. And then we're going to bring the analysis on the stock market. Arvi has got a great video where he's going to show you FEZ, that is the high caps in Europe, and what that means for risk into early 24. And then I'm going to bring you short-term analysis in SPY and the ongoing danger.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look at what might happen in coming weeks, and hopefully great ideas and opportunities for you going forward. Well, the stock market had another rough week as investors' fears elevated on the continued upside push in interest rates. The week started to the upside as investors briefly celebrated the government avoiding a shutdown. Well, that's temporary because there was a 45-day continuing resolution, and I call bullshit to that. And so did the House, led by fiscal conservatives who went and dumped McCarthy over making that kind of a deal. And such is politics, as the Democrats were happy to unanimously join in and do anything that could make things for the Republicans look like chaos. Of course, the Republicans would do the same for Democrats, giving the opportunity. Well, that Monday bump turned into downside selling as worldwide stocks moved to the downside, as yields moved sharply up, and we saw the 10-year yields get as high on Monday as 4.68%. They got higher than that later in the week. Tuesday was even worse, as Fed heads were out with some very tough talk, and the jolts came out, and that jolted the bulls, as it was much stronger than estimated. The S&P 500 was down 60 points, the Dow down 430, and the Dow moved to negative for the year. Wednesday was a bounce day as bonds rebounded and oil collapsed. It was a horrible day for oil, down $5 on recession fears. And that move up to $95, well, that was way overdone. It came way too fast, and it moved sharply lower from those levels. Thursday, markets also attempted a recovery, but that failed badly, as the Friday payroll numbers were much stronger than estimated, gaining 366,000 payrolls versus the estimate of 170,000. The U3 rate was 3.8%, and that held the same thing, and that is all very, very tight market indications. And that's not going to change the Fed's higher for longer mantra. Friday, the S&P 500 was down as much as 48 points. But here as we're recording, at midday, it has come all the way back to around unchanged, and the NASDAQ has moved to the plus side. So we have a market that is very volatile that we're seeing. But the stock market, the problems are much bigger than the payroll numbers, which really is a very narrow focus on what are some very big issues. Let's take a look at what we're going on right now as the government is in a period of massive spending, excessive spending, and that's during QT and a period of high interest rates. You know, what you get when you step on the accelerator and the brake at the same time is just a lot of smoke and a car going absolutely nowhere. Eventually, the Fed will let go and lower interest rates, and the economy will lurch forward, just as a race car does. Then inflation will roar again, and the doom loop will continue. And this is the sad situation of where we are now in our world and in our country, with governments that just spend way, way too much, debt that grows way, way too big, and a situation that becomes very, very untenable. And that will affect business and consumer and everything around the country. But more to say about that is China is no longer financing these U.S. massive deficits and debt. Huge borrowing needs will keep the U.S. rate structurally higher. They've got to find a way to sell this paper, and it's only going to be by rates going higher. This is a picture of what's happened over the last decade, really, where China was a huge buyer of U.S. debt, and they had around $1.3 trillion worth of U.S. paper, and they have been selling that off all the way through this year. This number now is down to about $821 billion, and China is most certainly not going to help the U.S. support this debt. That means that U.S. debt will be structurally higher. The cost of financing it will be structurally higher, and the hopes for the Fed to really change that very much are very small. Let's take a look one more thing, actually two more things here. This is the U.S. bond market crash, 2021 to 2023, in a weekly chart. And Bloomberg reports the 10-year market lost 46%, 10-year notes actually, and things that are a little longer than that. And the 30 years had a loss of 53% of their asset values. This is what has led this recent decline in the stock market. It took a long time for investors to really get a sense for the damage that is occurring here. And finally, the stock market is catching up. But I want to take even a bigger look at this because lots of people are looking for the peak to come fairly soon as the economy turns down. And that is probably not going to happen that soon. This is the U.S. bond market crash, looking at a monthly with our cycle analysis on it. And the crash is likely not over. There's still some more time to go here as we look at the cycle analysis here. This chart is a chart that shows you a repeating 17-month cycle. And what you could see here at the bottom is that where we are right now is about 12 months of the 17 off of that low right there. You can see here 17 months to that low, 18 months here, 17 months here, that big head and shoulders top that occurred. And now where we are is 12 months. That puts the ideal trough out into Q1 of 24 with a target here in the 10 years way down over here around 103.20. So while we may get some bounces here in the bond market, this crash is not likely over, and the scenario for the effect of it on the stock market is not likely over. So that is what's going on as far as the bond market goes, and structural changes in our interest rates here in the United States, and that is likely not going to change. Our work has shown that September-October was a period of risk for the stock market, and that certainly has come true. And I'll show you coming up why the biggest risks could still be ahead for the stock market. And Arby has a piece looking at FEZ where he's going to look at the high caps in the Eurozone and the risks into next year. But the bigger picture remains, as I showed you 9 months ago, that this is a cyclical bull market living in a secular bear market. And after the decline that we're in right now, there's likely going to be some upside after that. But the really, really big picture is that this is a period of reset for stocks, economics, and politics. And every intermediate favorable period, that's when there is some period of weeks that we think that the market is going to rally. For the stock market, those are periods to sell. We'll show you that in our bigger picture analysis coming up in months from now, some months from now, and why we think that new highs, all-time highs for the stock market, well, that is not very likely. This week so far has been a week of mixed results for the indexes. S&P 500 and the Dow down less than 1%, the NASDAQ up just a little bit, and the Russell loses over 3.5%. Most of that is because of the effect of the rising interest rates on those companies that lose money and borrow a lot. Bond market crushed again, the 30s down about 4 points. 10-year yields up 22 basis points. The 30-year yields up about 26 basis points, and 30 years got up to 5.05%. Gold market down $23 after going down big the previous week, and the silver the same thing, but even worse. Silver down about 80 cents on the week, and here at midday, of course, when we're doing this video. And this is a period where the silver and gold market are affected strongly by the strong dollar and by strong interest rates, as liquidations go on and people need cash and everything gets sold under those conditions. The dollar just slight gains, and we think the euro and the pound are making short-term bottoms here, and we're likely to see the dollar move to the downside fairly soon. Oil crashed, down $9 on the week. It had a high of 95, now comes down to 82, excuse me, on the concerns about a coming recession. Make sure that you watch FutureSpeak to get all of our analysis on all of the futures that we cover. That's 24 of them, weekly and daily analysis. And you need to be a level 2, 3, or 4 member to get that analysis. That is our opening for this week. Make sure that you explore our website. If you're new, get acquainted. Become a level 1 member, and you're going to get all kinds of information from us for just $45 for 3 months. On YouTube, subscribe to our channel, click the notification bell, and do like this video. Give it a thumbs up. On X, follow us at askSlim. And any questions you have on anything that I'm going to show you, anything about memberships and our offerings of education and analysis, write to Matt at askSlim.com. This is Trade Planning with Options. Katie is one of our experts in cycle analysis and on option trading, and she really knows that Tasty Trade platform. She's going to combine our analytical style with option strategies, and you're going to see a bearish options trade here in Google, and she'll tell you exactly why she sees that and what her strategic approach is to that. And don't forget, she's going to show you how to open up an account at Tasty Trade. That will help you with some specials from them, and of course that does help us. So Katie, show them this work.
Hi, this is Katie with askSlim, and this is Trade Planning with Options on October 4th, 2023. Today we're going to look at an options trade idea in Google. First, our legal disclaimer: the options trades that I demo and follow up on are trade ideas. When I talk about closing, adjusting, or managing them, I'm educating around management techniques, best practices, theories around risk management and profit taking, and highlighting aspects of options trading that we encounter as we follow these trade ideas. This disclaimer is specifically related to options trading. For full legal information, please go to the askSlim website or email Matt at askSlim.com. Let's get started. As I said, today we're going to look at Google. This is the weekly chart. Notice that we have a positively configured cycle here going into this weekly cycle timing window. That's the period of time between these vertical blue dashed lines, and it goes from October 16th to November 24th. At that time, depending on the depth of the retracement, we'll be looking for bullish opportunities, but for now we're looking at a short-term bearish opportunity. Notice that the reversal scout has turned negative. That's our proprietary momentum indicator, this green and purple ribbon on the chart. Now it's still quite flat, but the reversal scout turning negative in a positively configured cycle like this often indicates the peak of that cycle. Now let's switch over to the daily chart. Here we have a relatively large 40-bar cycle, and we are getting towards the declining phase of that cycle. Google had almost like a mid-cycle bounce here up into that resistance zone. The top of the resistance zone is at 134.60, and we have a 78.6% fib at 136.60. Momentum here is also negative with both the reversal scout and the slim ribbon. The slim ribbon colors our candles red, green, or gray, depending on momentum conditions. We have a daily cycle timing window coming up between October 13th and October 23rd. So we would expect this resistance area up here to hold, and so we are going to look at a short-term bearish trade idea going into this time period. We're going to go over to Tasty Trade, but first please go to the askSlim homepage, hover over the Marketing Partners tab, and click on Tasty Trade. They are our preferred options trading platform, and we'd like you to consider opening an account with them through our link. If you do so, that will earn you a special bonus, and it also helps us. Now on Tasty Trade, I have Google loaded in here. Notice that the IV rank is quite high at 46.4. We have implied volatilities in the 30s over in those expiration cycles. Now we are going to use the October 20th monthly expiration cycle because that aligns with our time frame going into that daily cycle timing window, and it also avoids earnings, which are on October 24th. The high IV rank makes this suitable for a short premium strategy, and I'm going to demonstrate setting up a short call spread. I'm going to sell a call around that 78.6% fib from the daily chart, which was at 136.60. So let's sell the 137 call. And now to set up the short call spread, we're going to buy a further out of the money call to define our risk. You can make it as wide as you like. I'm going to go out $10. So I'll buy the 147 call. That gives us a credit collected of $2.03. That's our max profit, $203. Our max loss is the difference between the width of the spread and the credit collected, so $797. That is also our capital requirement to place the trade. Our probability of profit is 69%. We get about 33 short deltas and a daily theta of about $6.85. Let's go and take a look at the risk graph. As you can see, we want Google to stay below our short call strike at 137, or at least below our break-even point, which would be 139.03. So that is also very close to our cycle peak. That is our options trade idea today. I will update the options trade idea tracker with this trade idea and follow up on it again next week. As always, please feel free to reach out on Discord or via email to katie@askSlim.com if you have any questions or feedback.
Loved it, Katie. Great job on that. Slim Ribbon and Cycle Analysis, Understanding the Market's Messages. This is a quick tools for text lesson. Using Apple, often you can get a sense for the condition of the market by using this analytical pair. It's, of course, one that I absolutely love. This is Apple without any cycle analysis on it. It just simply shows you the slim ribbon here, which is often a support or resistance. And you can see as it aligns with this analysis, using the 8, 13, and 21 exponential moving average, it gives you a sense of condition, of the momentum. And you can see in the bottom here the slim ribbon PO, which then tells you when there is momentum resumptions, whether it be to the upside or to the downside that you saw right over here. Now what I want to do is I want to marry it with cycle analysis, and I'm going to switch over to our daily cycle analysis here. And I want to give you a good idea as to the importance of this kind of analysis. First of all, you can see in the bottom our cycle brackets, and that is what's giving you a sense for the rhythms in the market. These are money flows, and this is a drawing tool in the bottom, which just gives you the ideal rhythm in the market. Now, when you see in here that these are forming bullishly, in other words, higher highs and higher lows, and especially marching up the slim ribbon, you have a very bullish condition. Now, the important part of this lesson is understanding how the slim ribbon tells you that the next cycle is either going to be positive or negative, or the conditions of the current cycle. If you see right over here where the slim ribbon turned negative right at this point, it told you that there was a likelihood that there would be a decline that would be sharp, that fell all the way through the bottom of the cycle. Here where the slim ribbon was positive, and here, each of these corrective phases was not very steep. You can see that. So I'm going to zoom in a little bit as you look at the more recent cyclical periods in here. And you can see what happened right over here, where this positive cycle became negative. So the slim ribbon positive, slim ribbon PO giving you the positive signals. But then once it gets under here and the slim ribbon turns negative, you're in a condition for a sharp decline. You can see that happened here, and that happened exactly right in here as it turned negative right here on that downside gap, and then continued through this cycle right over here to the downside. So now we're in this rising phase, and you can see it's pretty substandard right over there as Apple is rebounding. And the resistances are in here, as you can see, and our projection is saying that it is likely that because this cycle was negative, that it will fail right over here in this resistance area. So that's 176, 179, somewhere in that area, with an outside chance at 181, but I doubt that. Probably 176 to 179, and then turn down again. And assuming that the slim ribbon stays negative, the slim ribbon PO on the bottom gives you that red signal and the downside arrows, it will tell you that the conditions of Apple are negative and likely to get another hard sell-off here into this early November period. So that is showing you that there is a pretty negative overall condition in here, just as we saw in this cycle right over here and in this cycle right over here. It's likely to repeat here. If it gets above these levels over here, above 181.5, well, then it will be telling us a different story. But I don't think that's likely to happen. It's much more likely that this is going to fail and fall all the way down through this corrective period in this cycle, taking you out into that early to mid-November period. Overall, you could see the changing structure in here where this was positive, the slim ribbon was positive, the slim ribbon PO giving you positive signals, and now it turning negative right in here and getting the negative signals and the negative conditions that this tells us about the market. Apple, very likely to be a short sell for the short term, over 176 and maybe up to about 179. I like that trade. I hope this was a valuable lesson to you. That is looking at slim ribbon cycle analysis and understanding the market messages. Announcing, you're going to love this, the askSlim S&P 500 Daily Snapshot Lite. This is free, and you're going to get some things that we put out there every day on the stock market absolutely free, and it will be delivered to your inbox. You can sign up now at askSlim.com. This will be launching on October 10th, and you will begin to get our information free every single day. If you want information about that, anything more, then I'm going to show you now. Write to Matt at askSlim.com. This free information, the askSlim S&P 500 Daily Snapshot Lite, will include an exclusive glimpse into premium content. Dive into our renowned stock index report with our new free service. This S&P 500 Daily Snapshot Lite, you're going to get a taste of our premium insights that we offer without any price tag. You'll be able to master the S&P 500 with daily analysis applying our unique methodology. Gain an edge through comprehensive dive into the S&P 500's technical conditions. Our multi-layered approach brings together cycle analysis, momentum, swing analysis, and high-low analysis across various time frames. Our proprietary charts, well, you're going to get access to exclusive askSlim annotated 2-hour and daily charts, pinpointing critical levels of support resistance zones and a sum of the evidence price projection tracks. Our short-term price projections, well, you'll stay ahead with actionable trade planning insights. Our daily snapshot provides short-term upside and downside projections for the S&P 500, helping you navigate the market's volatile landscape. You'll get our momentum comparisons. How does the S&P look against the NASDAQ, the Russell, and which index will be the leader or laggard? Sign up for free at askSlim.com. Again, this starts on October 10th. And you can do that by going to the askSlim.com website. This is a picture of that, and you'll be able to sign up. Just put your name and email and hit subscribe. You don't have to do anything else. There's no credit card. There's nothing. We just want you to get a taste of what we do. And this is your opportunity to do that for free. Absolutely. Just sign up by going to askSlim.com and write to Matt if you have any questions on that. Stock market analysis and projections on the S&P 500. Some important information. Please do take a moment to read this slide. It tells you about our approach to the markets and what that means for you as you use our information. One more little announcement. You can see the top 60 named market pros in the next 6 days starting, well, it starts October 9th, and I'm going to be presenting October 11th at 10 a.m. How to ride the big impulses for greater profits. Plus, I'm going to talk to you about the biggest issues that prevent consistently successful trading. And there'll be a special offer at the end where we're going to announce our new day trader service. Plus, we're going to give away a cycle analysis workshop. Sign up at the top of the askSlim.com front page to be able to attend this great event for free. Sign up right now. Stock market analysis, S&P 500 short-term analysis. But first, Arvi is going to bring you a great piece of analysis here as he looks at FEZ, and he's going to show you the interplay between the S&P 500 and the FEZ and why risks will likely remain for the stock market into early 2024.
Hello guys, this is Arvi Ramachandran. In this video, what we're going to do is walk through our weekly cycle analysis on the S&P Euro Stocks 50 ETF or the FEZ. Now, note on Tuesday, we did our askSlim country ETFs video where we look at our intermediate term cycle analysis on 21 countries from all over the world. It gives you a great sum of the evidence understanding of what those core global money flows are doing, and this video is available to askSlim level 2, 3, and 4 members. What we see is that this blue cycle in the FEZ is also a very key cycle throughout the European markets, and they say that there's a low that's due 1218 to 25 in the FEZ. Now note, what we have done on this chart is we have added in the S&P 500 cycle bracket here in green, and there is a really key interplay going on here with the FEZ and the SPX. So let's just briefly highlight it. If we go back here to July of 2021, we formed our low in the FEZ and had a rally as we got into that rising phase, and then we had a test of the low as we formed our low in the S&P 500 cycle, and then turned back up after that, as the FEZ was still in a rising mode. After that, we curled back down as both the S&P cycle as well as the FEZ cycle were in corrective periods. That's this sell-off right there. If we go ahead now and move forward, you can see that we had both the FEZ and the S&P cycle due to form lows. That's this sell-off then, and then we had the rally as they both got into rising phases. What happened then is we then broke the low right there and then got into a left-hand translation in the FEZ cycle. Note, both of these cycles were once again due to form lows right in that late part of fall of 2022 as we formed a key bottom in world markets, and then we got into a rising phase with both of these cycles pushing up, and then we saw a sharp rally on the upside. What happened after that is we had a further rally and then a pullback right here into the S&P 500 low right there. Turned up again as the S&P got into a rising phase and then had one final pullback into the FEZ low. So you can see how beautifully that played out. Now, where are we presently? So we had a rising phase going on in the FEZ, but that is now over with on a close through this key intermediate term cycle low at 43.72. So that says that the FEZ cycle is in a left-hand translation where rallies are likely to fail. Note that there is a low that is due in the S&P 500 right around the end of this month, as we know. So we are watching for this to get a bounce off that S&P 500 low. But based on what we see here in terms of the overall cycle structure now in the FEZ, there's a high probability that this rally would fail and we'd still see lower into the end of this year, into the very early part of next year when the FEZ is due to form its low. So this is how we are using the S&P 500 timing to understand what influence it is likely to have on European markets. And the highest probability is that this rally that we would likely see towards year end is really set up to fail for one more hit on the downside into that likely very early part of 2024 time period. As always, if you have any questions or comments, feel free to send me an email. And if you are interested in joining us and seeing more of the videos that we publish throughout the week, please go ahead and sign up for a level 2, 3, or 4 membership at askSlim.com. Thanks again and have a great day.
All right, here's my analysis, and you got a little bit of the bigger picture looking at what Arvi showed you. And what I want you to see right now is the SPY, the S&P 500. Now, earlier in the show, I did a little piece on Apple where I talk about combining cycle analysis and our proprietary indicators, specifically the slim ribbon. And what I want you to see right in here is something that's really important in this analysis. When the slim ribbon is positive, as you see right over here, it's green. In other words, the slim ribbon colors the bars green in here. And when that's the case, it also colors the slim ribbon PO green on the bottom. And the PO gives you these upside resumptions and tells you when momentum is likely to continue on the upside. When you get positive slim ribbon in these minor cycles that you see right over there, what that tells you is that the declining phases, these little corrections in here, will be just that, little. You can see that. The slim ribbon lends support, and it tells you that the money flows are positive, and that it's likely that after these corrections, the market will move to the upside again. Higher peak, higher peak, higher peak, higher peak. Something happened right in here, and that is the slim ribbon went negative, and the price action got beneath this area right over here, which is the low of that minor cycle, and that told you something was changing. It told us that something significantly was changing also. So let's take a little closer look right in here and look at where we are right now. So first take a look here as this cycle was responding to the outflows of capital. As it showed you, it was negative in here, and the correction you could see, or the sell period, was steep. The same thing happened right in here as you had negative momentum, as you can see there on the slim ribbon PO or the slim ribbon. That then turned briefly neutral and positive and then turned quickly negative again. And once it went negative in here, again, a steep sell-off in here because the slim ribbon was negative. You can see that. Positive slim ribbon doesn't fall very much. Negative slim ribbon, then the outflows of capital are much stronger. Now you can see what's going on in here. This is what we call a left-hand translation. What that means is that the peak is on the left side of the cycle, and the peak here was only 3 days into this advance. Now what you have on the bottom in here, after it broke under this low, is just a lot of choppy action. And the slim ribbon, as you can see in here, is wide. It's red and wide and coloring these bars negative, even through this period where it's supposed to get some upside action. Well, it can't because this is such a negative formation that we have in here. And what this is projecting down to right now are lower prices. Let's just take a look right in here. And you can see that negative slim ribbon right in here is telling you about the momentum is being negative. Here's a downside resumption in momentum right over here, giving you a warning that, well, it can't really rally very much. When I say can't, I mean it is a very low probability. And you can see in here the minor resistances as we have in here. This is around 425. This is around 4 the middle of that is around 426. The bottom of this is around 424 and a half, and this right over here is around 429. So this area here between 424 and a half and 429 is a pretty tough area for that. Also, the slim ribbon will offer its own resistance, so we could get some more chop in here. The highest probability is that it will accelerate to the downside out somewhere here in this period. And generally, the strongest declining periods are right at the end of the cycle. See this last 5 or 6 days here. You can see over here what's showing those last few days. And that's this period over here where there is significant downside risk. Were the market to be able to get up in here and hold into here, then it could possibly only test this low over here around 419. We called 419 down to around 410 as the downside targets. So that's where we are right now. Looking for some more chop in here and failures to the downside, and then moving sharply lower out over here. Now, we always want to look at how can this turn out to be different. And that is, we have a minor warning level right over here, and that is at 429.40. If the S&P 500, or the SPY, gets over that level at around 429.40, it will warn us that the low that happened over here actually extended out over here. That would not change the scenario much. It might push these lows a little bit further out. It would then just tell us that the downside selling was so hard in here that it just extended out by some extra days. That would not change the overall negative scenario. Right now, the highest scenario is it will not get above that 29.40 level, and it will eventually move to the downside. If it gets above that level right over there, 431.85, that will confirm what I just said to you. This is the warning level at 429.40, 431.85 is a repair level that then just tells us that these resistances then come into play in a much bigger way. Again, that would just simply push out by some number of days the timing for this decline, but it would not change the overall negative scenario that we are looking at. Again, the slim ribbon and the cycle analysis combined together is a warning that these resistance zones will hold here, and that the upside, while the market could continue to try, is likely to fail, and the market get into a much stronger downside period in here that is out into late October, potentially out into early November. The bigger picture, again, that Arvi showed you, looking at the intermediate on the worldwide high cap markets, or actually the Eurozone high cap market, is suggestive of the fact that the low doesn't come till sometime early next year. And if you watch what I said in the beginning of the show, the bond market is suggestive that the lows don't come until sometime early next year. So while we are looking for a rally period to develop after this period, starting in early November and maybe even into December, that is likely not going to be anything really huge on the upside, and may actually stall in these resistance zones that we're looking at right over here. So we have been looking for a more favorable November, December. We are still looking for that, but overall, the bigger picture may not allow for much higher prices going forward. So here we are at the midday period on Friday, with the S&P 500 now up 10 after being down nearly 50. And you can see the market, as it has the last few days, really held near this support area down here. That's around 420 on the SPY. And the big question is, can it develop any real upside motion in here? Bonds look like they might get a little bit of a rebound, and that could continue to help the market do a little bit better also. But overall, the picture is not good, and it's just, will it move down here into this late period in October, or will it push out a little bit into this early period in November? That's, to me, the only question, and the bearish conditions remain. That is a look at the stock market. For those of you that are getting our market condition monitor, there's been an upgrade in there. And what I want you to do is to take a look at how you can now get in our MCM Pro version alerts regarding when the analysis that we have does change as far as the conditions of the market. So take a look at that. I think that is very important. That is it for the market. I want you to get our free information. If you're brand new to askSlim, you're going to love this. Sign up for the SIR Daily Snapshot Lite. It's free. Just go to the top of our homepage and sign up there. You'll get it delivered into your inbox every single day with some of our very important information on the S&P 500. So take advantage of this great free offer. That's going to be it for us here. Please do go to askSlim.com, get acquainted, sign up for level 1. You're going to get our full information in the stock market every single day, just $45 for 3 months. And subscribe to our channel, click the notification bell, like this video, give it a thumbs up, watch our member videos in the playlists, and on X, follow me at askSlim. Any questions you have on anything I presented here, write to Matt at askSlim.com. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been